Welcome to the Daily Update, where I'll go over the action in the market for Friday, February 9th, and then we'll see how things look for Monday, February 12th. Well, we now live in a world where we not only have walked on the moon, and I did see that happen. There's a lot of doubts coming up about that. And now we have an S&P 500 that is above 5,000. Okay, that's a good sign. Setting all-time highs, that's positive. But as always, there are some things we need to be concerned about. And so the fact that we're going up and reaching a plateau we've never reached before, not only an all-time high, but above 5,000 on a decrease in volume, that doesn't bode well for confidence, at least right now. That could change, but to this point, it's a warning sign. We're also potentially coming up into the middle part of February, which lasts until about the middle or so of March, of historical weakness. Doesn't mean it's going to play out that way this time, but when you take all the years together and the kind of years that they are, whether it's an election year, pre-election year, what have you, and put them together, there is some concern that we're coming into this time that could get weaker. We're also dealing with a continuation of an overbought condition, and that could also bring in some selling at some point as folks want to lock in some profits. So let's go back and talk about what happened. Right at the open, we opened above 5,000 right off the bat. The pivot levels were really close to each other in Friday's session because Thursday's session was anemic as far as price movement. So we quickly went above R1 at 5,003. We got up to R2 at 5,008. Notice there's only a 5-point difference between these pivot points. Then after we got above R2, prices then fell back down to R2, and then we climbed up to close above R3 at 5,022. We were up 0.57%. This is a concern on below average volume. We are positive with our technicals. You can't doubt that. You don't set all-time highs without being positive, but we are looking overextended in the short, intermediate, and even to a degree, the long term. And then we're also going to get some big inflation information this coming week. We're going to have CPI and PPI and retail sales coming out. This previous week, it was pretty slow as far as economic reports, so the market didn't have a lot to key off of. That I'm attributing the two real slow days that we saw is because the market didn't have anything to go from. Well, that's going to change in the upcoming week. And that's also going to shift part of the scenario with what the market is anticipating with the Fed. We're also keeping an eye on the different geopolitical events, but as I've also been saying, I watch these things pretty closely, but they don't seem to be having much of an impact on the stock market. There's some things going on in Guyana, I believe it is, that has to do with oil, but that's more specific to Exxon, and that's more isolated in what's happening there. Some comments. We did close above 5,000. I've already stated that a couple of times. And not only did we set an all-time high with the S&P, we set an all-time high with the NASDAQ 100. That's because there's a lot of stocks that are in both indexes. The Dow ended up being down for the day, but the rest of the market did pretty well. So the advance was fairly broad-based. We did see the mega caps do well. We saw the mid caps and small caps do better, and we saw other stocks within the S&P show some improvement as well. But here's our list. In the short term, looking at overbought or extreme positive conditions. First, we have the Stochk RSI. That is a new addition to the list. That's a pretty touchy indicator. It's been fluttering around. Well, it finally went extreme positive. We have the Williams percent R, which has been on the list for a few days. The CCI 14 and 20, which has also been on the list. The stochastics, which have been on the list since about December. The standard deviations chart, we're still looking pretty extreme. We're up in the +3 standard deviations channel. The boom indicator, yes, we are getting a ways away from our 20-period moving average and the RSI based on 9 periods. And in the intermediate term, we also have a little bit longer list here. Another one that was on the list a while ago and now is back on is the rate of change going back 50 periods, meaning that we've been moving up pretty far, pretty fast. Our oscillators, and I'm not restricting that just to the PMO. I'm looking at all of the different oscillators on that whole chart that we look at each time. we're getting pretty extreme. We're positive there, but we're getting some pretty extreme readings. The Sean trend meter, the NASDAQ 100 bullish percent index, it's still above 70, where the S&P 500, it's going back up, but it's still not extreme at this point. The money flow index, the Chaikin oscillator, the boom indicator based on 50 periods, as well as the RSI based on 14 periods, and then our longer term new high, new low study that seems to have been on here forever. We're also still looking extreme when we look at our 150 and 200-day simple moving averages. The current scenario hasn't changed. We're going to see if there's going to be some modifications in the upcoming week. It's looking more and more like the Fed is done raising rates. So the market isn't as concerned about that right now. It's how long are they going to keep rates where they're at? And right now, they took March off the table. Now we're looking to May. And the economic reports that are coming out will kind of dictate whether that gets pushed back even further or if May looks more likely. The dollar was down, which gave some support to stocks, but this is also another concern. And I don't have this on the warning sheet. I should have put it there near the end of the video. We keep climbing with interest rates. We're at 4.19% for the 10-year yield, and interest rates have been going up as the S&P has been going up as well. And in this kind of an environment, that's a negative warning that we want to be aware of there. We still have the yield curves that remain inverted that we've been following for a long time now. Sentiment is extreme positive. This is another warning sign that we want to be aware of. We're above that 75 level. We had ticked up to 77. Then after Friday, we ticked up to 78. When we get to this high of a reading, this is when we start to look at using this as a contrarian indicator. Our trend is positive, and the ADX is actually getting stronger. We're starting to come back above the moving average, both in the short and intermediate term. And so I should have changed this. This should mean it's going above its moving average. Our bias is positive because we had the update, and the last number of days when taken together for our momentum, they continue to be positive. We didn't get any economic reports in Friday's session. It was kind of a surprise. I think the futures ended up being strong, and then that shot us higher. And then we just stayed up there because the market didn't really have anything to really help it all that much. There was some adjustments in inflation rates that weren't official economic reports that the market seemed to like, and they didn't get modified that much. So the market is feeling a little bit more comfortable with looking at inflation. On the positive side, though, you can say, okay, we're at high levels that we've never been at before. We're not really seeing any selling, at least yet. Now we have to keep a watch on things because that could change at any time. Don't have any charts to show you. Here's an Isabel Net chart. Now, this was put out before Friday's session where it says 5,000 is so close. Well, we're there now. And you might want to go to the website. I think I have the link in the description. What happens when we set new kind of milestones for the S&P 500, and then what happens going forward from there? And then we're looking at cyclicals, and these tend to be more when the economy's doing good, cyclicals do well. When the economy's having some problems, defensive stocks do well. And we've seen here where the cyclicals have been outperforming, and they still have some more room to run. But as it's looking like the economy's not falling apart, the debate is still out there whether we're going to go into a recession or not. But for right now, we're seeing growth that isn't getting too far out of hand. So we're seeing the cyclicals tend to outperform the defensives. And then we're still seeing where the large caps are outperforming the small caps. We thought, okay, I think this little blip right here was the January effect that happened for just a short period of time. But when you take the bigger picture look, we're seeing where the large caps are doing much better. Here's our intraday chart. You see where the pivot points are very close to each other. I had to put R3 on here, where we actually opened right at R1, quickly went above R2, came back down to R2, and then we just kept going up. We didn't really see any massive selling. We got up to R3, stalled there for a little bit, and then broke above that, came back down to R3, and then closed slightly above R3. Here's our intraday chart. The initial overnight session, we were pretty much flat. We started to see some strength in the pre-market session here. This is what built into the open. In fact, it was higher and actually came right down as stocks were opening. And then we just trudged along higher and we're pretty much flat as the market closes for the weekend. We are still seeing the green line on top. Now, these are on different scales, but this is a way to kind of get a graphical look at this. Did I say green? I meant blue line is on top here. That means the growth is outperforming. When the blue line is on top and the red line's underneath, that tends to be more positive for the market. Here's an intraday ratio where this is still looking good. We started to hit a bottom here in about the 31st of January, and we've been seeing pretty much a climb overall on an intraday chart. So this is also pretty healthy for right now. Some end of day charts where growth was up for the large caps. It actually ended up being down when we look at value for the large caps. For the mid caps, growth outperformed value. And for the small caps, they really outperformed value there. And I like to point out the areas in the middle here, these are the ETFs that correspond to these particular indexes. Then this is encouraging for the small caps. We've been in this sideways range going back almost a year now, and we couldn't seem to get above that. We're really starting to see small cap growth outperforming small cap value. This is about the fourth day in a row now that we've seen this ratio really going up. We're not seeing it really reflected yet in the index, but we are seeing it more under the surface. We're also seeing some improvement here with the mid-cap growth to value ratio, where we're breaking out and starting to go up here, even though we're not really breaking out yet when we look at the index. We're seeing some improvement with S&P growth to value. This is also showing a lot of improvement, but we're not back to this previous high yet. And here's the other growth to value measurement that we look at. We're above the rainbow. We're not back to this previous all-time high that we set in late 2021. But the fact that this is going up right now, that's positive. And when we're seeing a little bit of improvement when we compare discretionary to staples. When we look at the ratio, we're coming back up to this previous high. But this has been a negative divergence as the S&P was going up. We saw this going down, and now it's starting to get a little bit of legs behind it. We need to see more follow through here to remain more positive. Now, if we do start to see a pullback, we're going to be watching growth to value and discretionary to staples really closely, because a lot of times this is when the smart money comes in and they start buying on declines, knowing that, okay, eventually we're going to get beyond this. And now we're already set up in some positions where we feel that we can make some really good profits. So that's one of the things that we watch as things are going down, but we haven't started to go down yet, and we're not quite sure when that will happen. Keeping an eye on our trend, we are starting to break a little bit above the moving average. So this is suggesting a strengthening trend. It's positive with the green line, but we're getting back up to this 40 level again. But we shot well above the 40 level back in December of 2023. But we just want to be aware of this when it's starting to look a little bit extreme. And in the short term, we're also just a little bit above 40 with the green line. We are showing a strengthening trend. We're actually declining now with volume. This is a concern, and we're above average when we look at our oscillator, but we were below average when we just take the one-day figure. Keeping an eye on sentiment, we're pretty much not really changing all that much with the Ulcer Index, but we're still getting pretty low readings overall, suggesting there's not a lot of fear. We turned up just a little bit with the VIX when we look at the line chart and the bars. The last couple of days, these intraday bars have just been minuscule, and we're actually ticking down just a little bit with the VIX of the VIX. We started to show a bit of an increase here, meaning that maybe volatility will pick up. Well, in Friday's session with the update, that actually ended up declining. We're still declining now with our equity put call ratio. This is the daily chart. So when we look at the 5-period chart, we're continuing to go down, and that is positive for stocks. We're coming off of an extreme reading with our VIX to S&P 500 correlation. Now, typically this is negative, but we're not seeing that so far. If you look at other times when we had an extreme reading and then what the S&P did after that, it typically got under some pressure at that point. We're coming back down more to a neutral reading without necessarily seeing any kind of a decline, at least yet. But when we look at the skew index, we're still up in this extreme area where the market is still anticipating some kind of a big move. Is that going to be a push higher, or is that going to be some kind of a push lower? We don't really know just based on this chart. We have to use other charts to get some context. We're looking better here when we look at the advanced decline line based on price. We're finally starting to break out, but we haven't broken out yet based on volume. So volume is lagging a little bit here. We're looking a little bit better with our new highs, new lows. There was a lot more new highs than new lows. You would think this would have just spiked all the way to the top once we got above 5,000. That's also suggesting that not all the stocks are participating in the move of the S&P 500. We're still underneath the moving average with our 5-period, although we're trying to turn back up, and we're starting to go back up with our 10-period moving average. We are still above zero with the advanced decline ratio. That is positive. Accumulation distribution is still looking positive. This suggests that the smart money is still buying. The one thing that we might be a little concerned of in this chart is we're starting to get kind of far away from this moving average. And the Chaikin money flow. This is another smart money indicator, also showing some improvement and not necessarily giving us an extreme reading right now. But we are starting to get more extreme with the Chaikin oscillator. We crossed above this red line. Now we're approaching this green line, which is when we do have a more valid extreme positive reading. We did see some improvement now for the last couple of days over the NYSE advanced decline line. We're also going up with our trend. That's the red line here. And then the black bar chart is the S&P 500. So we have the S&P 500 index and then a broader measure of what the market is doing as far as advancing or declining. When we look at our advanced decline line studies, we are going back up with the common stock, but we haven't surpassed this previous high. We are showing some improvement with the S&P and just barely starting to break out. Some improvement with the mid caps, but not back to this previous high set back in December. We're finally crossing back above the moving average with the small caps. So this is showing some improvement after it had been lagging. Here's our daily chart. Still looking pretty healthy when we look at just the bars all by themselves. We're breaking out. We do have some overhead resistance here with some pivot points here that if we continue to go up, we might bump into those things. And then volume the last couple of days. Here we are at setting all-time highs and then above 5,000, and we're seeing a decline in volume. The perma bears, they're just going to pick up on this and run with it until they can't run anymore. And there's some validity to that, but we still want to see, does the market, is it going to have a chance to recoup itself, redeem itself as far as volume is concerned? But for right now, we need to be aware of this. Here's the Stochk RSI, which is starting to get extreme positive. That's a new addition to the list. The Williams percent R has been on here for a while. It's extreme. The CCI 14 and the CCI 20 are also extreme. These are our short-term indicators. They're very touchy. And when we get any kind of a move, it's not, or I should say, it's common to see this list start to grow. We are showing a little bit of an improvement here with the 20-period. We were flat to actually slightly declining with the 50-period, and we declined just a little bit with the 200. And not sure to read too much into that right now. It's a little bit of a concern. When we set an all-time high, we would expect these moving averages to go up. We're still looking okay with the force index. This is also another short-term touchy indicator. We're above the midpoint and continuing to go up. We're still extreme positive in the short term, intermediate short term, and long short term. And again, I subdivide the short term in even further chunks here. That's why we have 3 different charts. We're actually going outside of the +3 channel with our standard deviations chart, meaning that maybe we've overdone things. Intermediate term, we're still looking positive with the balance of power. The go-no-go system is positive. We're still hugging the highest high value and looking positive. The TTM squeeze is looking positive. We're coming up to this black line. Now, I put this black line on here. So there's nothing magical about it. I just use it as some kind of a reference point that when we get to this kind of a reading, there's other times when this marked an extreme reading. This is also kind of a concern here. We're seeing the ease of movement decline, and we've seen that the last couple of days. We have the S&P setting new highs where the ease of movement, this tries to measure the path of least resistance. And when this is going down for the last 14 periods, it's not boding well for confidence when we look at this chart. We're continuing to go up and almost getting extreme when we look at the Erin indicator, because we have the green line on top, that's buyers. The red line continues to decline, that's sellers. And the difference between the two is what the oscillator tries to calculate. We're showing some improvement here, but we're still negative with the McClellan oscillator for the S&P. It's still below zero, even though it did come back up. That's in the shorter term. We're setting all-time highs, but not being confirmed by a move in the McClellan oscillator. Longer term, the S&P was going up as the McClellan oscillator was actually going down. So we continue to decline with the summation index based on price. That's another warning sign. This is pretty good at picking up the overall trend. And once we topped out right at the end of December, this has been declining ever since. We're pretty much flat right now with the summation index based on volume. We are turning a little bit more positive in the broad market, though. We've crossed back above zero with the NYSE McClellan oscillator. So that's showing some improvement, but still, with the S&P going up the way it has been, we want to see this also participate, and it really hasn't been doing that. We're just barely starting to turn up with the NYSE summation index based on price, but we still continue to decline based on volume. That's another little warning sign. We're above zero with the Swenlin trading oscillator based on price. We're just barely below zero based on volume. So this is a bit of a contradictory signal. We continue to go up on a momentum basis with our PMO, but we're above this red line, so we're extreme. That's the positive side. The negative side is we're turning up, but we're still below the moving average based on price. We're right on top of the moving average, and both are declining when we look at volume. Another negative divergence to be aware of. Nothing really extreme here. We saw a little bit of an improvement with the percent of PMOs that are rising, a bit of a tick up with the buy signals, and we continue to decline with the PMOs that are above zero. Again, should this really be going down as we're crossing above 5,000? Just a question to ask. But when we look at just the trend, we are positive with the Elder's Impulse system for the S&P. We're also positive with the parabolic SAR. We're positive with the slope oscillator, and we're positive with the MACD. So with all of our oscillators getting extreme in the short term with the slope and TSI, not necessarily extreme with the MACD, turning back up and not necessarily extreme in the intermediate term when we look at the PMO and PPO, not really extreme yet, but we're looking more positive in the long term. So our oscillators have pretty much switched back to positive now, but in the short term, we are getting concerned about it being overextended again. But the market can do that for a long time. It can remain overbought. And we're above all of the plotted moving averages here. And we're starting to tick back up with our bullish percent index, but we are seeing a negative divergence longer term. We topped out right at the end of December. The S&P has been going up. The bullish percent index has been going down. Now it's finally starting to tick back up, and it's not extreme. We just barely turned back up with the NYSE bullish percent index, but we're above 50. And we're turning back up with the NASDAQ 100 bullish percent index, but now we're more extreme when we get above 70 like we are. We're still extreme with the money flow index, and we're extreme with the ultimate oscillator. We're actually starting to go down here with the vortex. The green line's on top. That's positive, but the fact that this is going down is a bit of a concern. We're extreme positive with the RSI based on 14 as well as 9 periods. But when we look at on-balance volume, this continues to be quite positive. And this is another concern. Setting new highs with the S&P, seeing a negative divergence here with our 200-day moving average study, and it actually declined. Also, setting a new high, actually been declining with our 50-period moving average study. And when we look at the copy curve, it's rolling over a bit, but it's still positive. We came down a little bit with the Sean trend meter, but we're still extreme positive. We're just kind of extreme. When we look at the boom indicator, that's how far away are we from the 20 period and 50 period. Those are extreme. We're still showing some improvement with the 200 period moving average study. And then when we look at all of our different charts that measure the trend, we're still positive with the Heiken Ashi. We're positive with the Kegi, positive with the Renko, and positive with the 3-line break. We haven't moved enough yet to see a new X in the point and figure chart. So that's why I haven't included it here. We're starting, actually, we've become extreme again with the 150 and 200-day simple moving average study. And then we did see a nice little improvement. The red line, which is the equal weight S&P, that's actually moving a little bit above the S&P. So that's positive to see more broad participation. And we were up just a little bit with the ratio, showing that the mega caps also had a good day. So this ratio continues to go up. We're still bumping into underside resistance here with the Dow. We bumped into this, well, 3 times. We didn't quite hit it in Friday's session, and the Dow ended up being down. So we've switched over to neutral for the Elder's Impulse system for the diamonds. NASDAQ really looking pretty good, starting to break out above these R1 levels. So that's looking better, but we're not back to an all-time high yet with the NASDAQ. We're also continuing to be in no man's land here. Would have to get way back over and match this previous level to set a new all-time high. This is also encouraging. The NASDAQ 100 looked like it might have been bumping into this R1 level, which was acting as resistance. We were able to break above that. So that's looking more positive. And we continue to be positive with the QQQs when looking at the Elder's Impulse system. We're starting to turn back up, not with an awful lot of conviction, but the PPO is starting to go up, suggesting that the NASDAQ 100 momentum is positive. Showing some improvement here with the small caps. We got above this pivot point now. And then yesterday we were able to get above the 50-day moving average. Can we continue? Are we going to see a nice little up thrust and then give back, or is there going to be some real legs behind this? And we continue to be positive with the Elder's Impulse system when looking at the small caps. This is another positive thing for the small caps. We got above and closed above this resistance level. Now, we've done that before only to fall back. We need to see more follow through to turn more positive. The RSI has crossed above 50. That's positive, and we're just starting to cross over positive with the momentum. So for right now, on a shorter term basis, the small caps are showing some improvement, but we've seen that before, only to see it give back a lot of that over the next few sessions. The mid caps also breaking out above this R1 level. Not quite back to this previous high yet, but we continue to be positive when looking at the mid caps for the Elder's Impulse system, setting an all-time high with the FANG index, still hanging in there and doing pretty well with the financial sector. So we're keeping an eye on New York Community Bank. It ended up being up, my gosh, 16.95%. That's a nice little bounce there. But still, it had been at 10.5 just a week or so ago, got all the way down to 4, and is now showing a bit of a bounce. We saw a little bit of a pullback with the dollar, and we also are in a longer-term downtrend here, but we've been bouncing overall fairly well since the start of 2024, and that's been putting some pressure on stocks at times. Other times, it's like stocks don't even care. And this is another thing they don't seem to care about. We continue to go up with the 10-year yield, where we're continuing to go down with the 10-year based on price. And then looking at our growth to value ratios, turning back up just a little bit with the Qs to S&P. Discretionary showing some improvement, but still below a declining moving average. That's an area we want to see some more follow through from. But we're showing some real strength here when we look at large cap growth versus large cap value. So with the large caps, mid caps, and even more with the small caps, we are seeing some pretty hefty positive signs for right now. We're coming down, but still positive with our 10-day average of the S&P 500 highs minus the lows. We're still positive with our broad market range of the highs minus the lows. We continue to go up with the S&P to utilities ratio. We continue to go down with the staples to S&P 500 ratio. These are all positive things for the S&P. So what's our outlook for Monday? We are positive. We are overbought, especially in the short term, and even to a large degree in the intermediate term. We still have to ask this question. Is weakness starting to develop? We're seeing an awful lot of negative divergences here. That if you read a book about technical analysis, all the things that they warn you about, we're starting to see played out in real time right now. The big one being that we're really seeing volume decreasing. Now, we have to ultimately follow price. And if you try to front run this with a market that has a momentum to go higher, you could really get some pretty hefty losses. You probably want to wait and see some kind of confirmation that we're actually looking more negative before you either get out of long positions or actually try to short the market. That's just my approach to things. You can, by all means, do whatever you want to do. We're going to get the Treasury budget in Monday's session, not a big influential report. The big ones are going to come later in the week. We will keep an eye on the geopolitical events. This is also Super Bowl weekend. hoping that everything goes fine there with everybody that will be watching, and that whatever team wins is the team you want to win. Here's the upcoming economic calendar for the week. We're going to get CPI on Tuesday, retail sales on Thursday, and then PPI on Friday. Pretty hefty week for economic reports. Seasonally, we do tend to be more neutral to positive across the board with the Dow, S&P, and NASDAQ for the 12th. We're coming into options expiration week where we're up a little bit more than we're down for the entire week. Seasonally, when looking at this chart, we do see some positive seasonality. We're also looking at positive seasonality with this chart, but we could be coming into that period of time when we might see some weakness according to the Stock Traders Almanac. It's a little bit more pronounced on this chart, where we come up around the middle part of February, and then we see some weakness going into the end of February, and then a little bit more weakness possibly going into the middle to even latter parts of March. That's just seasonally what has happened. We'll have to see if it actually plays out that way, but it's good to know about this ahead of time. February does end up being the worst of the 6 best months. And I should have switched this over here. Monday is the most positive day of the week, especially if your team wins the Super Bowl. We will be on the 8th trading day of the month, where we do see some positive seasonality for an election year. The green dashed line is actually going up. Our scenarios, we just can't go with the down one. No matter how many warning flags we see, we can't really switch to being negative until we see confirmation with price, and that's just not happening, at least yet. It's hard to go with the up one, but that's what we would default to because our technicals are positive, but we are overbought. We have to ask this question. We're seeing a decrease in volume. We're wondering these negative divergences. Is the market going to have to reckon with those at some point? We're not going with the sideways trend now because we are showing a strengthening trend both in the short and intermediate term. The warning signs: volume is decreasing as the S&P moves higher. And we've seen that for the last few days now. The risk on posture is chopping sideways. It's just been bumping all around and it's just not giving us any insight. We are extreme with our S&P 500 oscillators. The McClellan oscillators and summation indexes continue to negatively diverge, even though some of them are showing some improvement. Small and mid-cap growths are negatively diverging from the S&P. Now, they've been showing an improvement, but they're not back to all-time highs yet, the way the S&P is hitting an all-time high. Discretionary sector is negatively diverging from the S&P. The transports are negatively diverging both from the Dow, which is longer term, and the S&P, but I haven't been showing those charts because that's been going on for quite some time. And we are seeing some improvement with the NASDAQ 100 when we look at momentum. And then stocks are entering a period of historical seasonal weakness. Historical means that it has happened historically. Is it going to happen this time? We don't know. But stocks do have a tendency to follow these kinds of patterns. And this is about the middle of February to about the middle of March. Positive signs: growth is showing an improvement. Our oscillators are positive, but they're also extreme positive. The equity put call ratio based on 5 periods is going down. The parabolic SAR and vortex charts are positive. The bullish percent index for the NASDAQ 100 is positive, but it's still above 70. The Copic curve is positive. Small and mid-cap growth is now positive and showing improvement. Financial sector is positive as well. So our conclusion: we are positive, but we're overbought. We still wonder, is weakness going to enter at some point? Volume is decreasing as prices go higher. And we're still kind of seeing that same thing across all the different time frames. We are overextended to the upside, but we remain positive. So I hope you found this helpful. I hope you have a really good weekend. I will be posting the weekly video as well as the intermarket analysis video and the deep dive video. So have a great weekend, and I will talk to you in the next video.